90.3 WHPC now presents Law You Should Know. The law affects every aspect of our lives, our home, our jobs, and our recreational activities. Now, learn about the law and how to protect yourself against the loss of your liberty or property, and learn how to stand up for your rights and seek compensation when you have been wronged. Your host for Law You Should Know is attorney Kenneth J. Landau, a past dean of the Nassau Academy of Law, and frequently lectures to lawyers on ethics and avoiding problems with clients, and to the public on how to choose and use lawyers. This is Law You Should Know on the voice of Nassau Community College, 90.3 WHPC.
Hi, this is Ken Landau, and welcome to Law You Should Know. We're honored to have back Karen Tenenbaum. She's not only an attorney, but she's a CPA and has a master's in taxation, a master's degree in law, and she's an expert on taxes and resolving tax problems with the IRS or New York State or any other taxing authority. She is the expert for accountants, for corporations, for anyone out there who has problems or potential problems with the IRS. And we'll hear about the many ways she can help people and tips on how to avoid problems with the IRS and the New York State Tax Authority. She's also the chair of the Suffolk County Bar Association Tax Law Committee and very involved with New York State Bar Association as well. Karen, welcome back to Law You Should Know, and congratulations on the 25th anniversary of your firm specializing in tax issues.
Thanks, Ken, for having me. It's always fun to be with you.
And unfortunately, the people are still having problems with the IRS and the taxing authorities, and you're still around to help them, which is always good.
And I can tell you that they were pretty lenient for the last year and a half during COVID, but now they're getting aggressive again, and especially New York State. So Thanksgiving was on a Thursday, and New York State started taking collection action again the day after on a Friday. And on the Monday after that, the phone started ringing and has not stopped. December, January, February, March have been a trajectory.
So if someone gets a notice from the New York State or IRS, or what should they do?
So first they should open the envelope, because a lot of people are afraid when they don't laugh, it's true. They get these envelopes, and sometimes they come to visit me, and there's a stack of envelopes that they never opened. And I say that the problem just gets worse if you don't deal with it face on. And you really should either try and deal with it on your own or get a professional involved to resolve it once and for all, so that interest and penalties are not accruing, and that you either enter into some kind of agreement with the IRS or New York State that you're going to pay less than you owe, that you're going to pay over time, or that you're currently not collectible, that you're going to do something so that it's not lingering over your head.
And ignoring it is the worst thing, because the problem will not go away.
Exactly. The problem does not go away.
You might be able to help it go away, but it's not going to go away on its own.
Right. And some of these liabilities that are personal, some of them, like sales tax, do not go away in death or in bankruptcy.
And so let's talk about as we emerge from COVID, there might be questions about where the person actually worked. Maybe they worked in a different city or state from where their employer is located. So what are some of the problems people may have in filing their taxes for this year, or because of what they did last year, and even moving on to 2023? Yeah,
a lot of people work from a remote location. And New York State says two things. First, if you're domiciled here, meaning you always lived here, you're still domiciled here unless you've changed, and you have to meet all the factors that we've gone over in other shows. But if you are non-resident, so let's say you lived in Connecticut and you used to commute to New York, New York State says, again, nothing has changed. So they still want you to pay taxes to New York unless you meet one of the exceptions. That you have a bona fide office somewhere else, that your employer agrees that you have a bona fide office somewhere else. We see a typical situation where in March of 2020, a lot of people who lived in New York City moved out to the Hamptons or somewhere else. They're still a New York State resident, but they say we're no longer a New York City resident. Well, guess what? 2 years later, a lot of them are moving back. And now New York have the benefit of hindsight. That you did move back. What has really changed? Did you really have an intention to change your domicile? You would have the burden of proof by clear and convincing evidence. So it's very confusing. Where do you file? And each state has different rules. And I would say you get a qualified accountant to help file the tax returns.
And it's important, if you think you may have a problem, to explore your options. People should speak to you or perhaps see their accountant to try to plan their best scenario before there's a problem.
Well, for sure, you want to avoid double taxation if you can. And what we're seeing is that New York State has already sent out over 100,000 notices to non-residents saying we're not sure that you filed your taxes correctly for last year. It's a desk audit. Normally you see residency as a field audit. But these notices are going out and some people are just paying it. They're just like, okay, I'm not fighting it.
But it's worth, usually if enough is involved, it's worth exploring their options about fighting it.
Oh, absolutely. You should call a professional. We'll give you a free 15-minute consultation and we'll explore your options, of course.
And if someone does owe money for this year, for past years, to the IRS in New York State, what are some of the consequences?
So the government can do a lot of things. They have an arsenal of tools. They could take money out of your bank account. They could take money out of your salary, wage garnishment. The IRS takes out almost all of the money from your paycheck, whereas New York State takes 10% of your gross wages. They don't. It's also different procedurally. So the IRS will give you notice in advance of the levy against your bank account. New York State just takes the money. They notify the bank and they give the bank 90 days to turn over the money. The IRS, it's a snapshot. It's whatever money is in the account at the moment that they send the levy. And you have appeal rights on the federal level. You don't have appeal rights on the state level. It's really an opportunity to call the government and say, you know what, it's payroll day. You're taking money out of my company's account. I want to continue to be able to pay you and pay my employees. So how about if we chat? How about if we negotiate? I'll give you a down payment. We'll make payments over time, and you come up with some reasonable resolution.
And again, you or their accountant might be able to help out to work out a plan that they can
Absolutely.
meet.
So a lot of people don't even realize, you hear all these ads for resolutions on the radio, on TV, pay 10 cents on the dollar. It's really based on your ability to pay. There are other, there's debtors to liability, debtors to collectability, and economic hardship. So there are other alternatives. But for the most part, it's your ability to pay. And so if you don't think you'll ever be able to pay the full amount based on your income in the future and your income over expenses that are on a chart with the IRS, plus net equity in your assets, you might have to end up doing an installment agreement where you pay the full amount with penalties and interest continuing to accrue. Or you could say, I'm currently not collectible. Check with me in 2 more years.
So talking about those ads that talk about paying 10 cents on the dollar, those ads are run by some service. We don't know where they are. We don't know who's doing the work. You're a professional accountant and lawyer in New York. It's always best if someone hire a professional licensed CPA or attorney, or even better, a tax attorney, to evaluate and resolve these issues.
So a lot of the people who come in for a consultation have often gone to these other companies and either have not gotten a good result or haven't even heard from them. Also, a lot of them only do federal and don't know what to do on the state level. We handle, both IRS and New York State regularly. So I would say you want to go to someone who knows what they're doing and who has experience. We're doing this. My firm is, as you mentioned, we've been doing it 25 years with the firm. And next year, I'll be doing it for 40 years.
And if someone buys a business, are there circumstances where the buyer could be responsible for the seller's tax liability?
Yes. And before I actually get to that, I want to add one more thing to the arsenal of tools that the government has. If you owe more than $55,000 to the IRS, they could take away your passport. And if you owe $10,000 or more to New York State, they could take away your driver's license. And so what we're seeing is now that the world is opening up again to travel, we have a client who's an international business, and they took away his passport. We were able to just get it back. And we have a friend who was going on vacation to a Caribbean island in January and called us up the month before to say, oh, my God, I'm embarrassed to tell everyone I'm going with that they took away my passport. And we were able to help him as well. But now let's talk about a business. So in New York State, if the seller has sales tax owed to New York State, the buyer, the purchaser, will be liable. The entity that's buying those assets will be liable for the prior owner's sales tax, and he will be personally liable. There's a new case that says it flows through to him personally. So New York State has a bulk sale filing requirement 10 days before the sale happens, the closing. You want to file with New York State, and then they come in and tell you how much is owed, if they're going to audit, and what to do. Otherwise, you have to put money in escrow equivalent to the higher of the fair market value of the assets or the purchase price. So I'm going to give you a few scenarios that are pretty scary. One, we had a client who, before he came to us, knew he was buying a company that had a liability, went to New York State pre-COVID and said, I know the guy owes money. How much does he owe? And New York State said $10,000. The guy wrote out a check for $10,000, and it was stamped paid by New York State. He got a receipt and everything. Turns out he didn't do the bulk sale filing, and it turns out that New York State made a mistake. The number was $100,000, not $10,000. And they said, you didn't follow the strict rules, and you owe the difference. He came to us. We were able to work something out, but you don't want to be in that position. Another situation, a well-known food franchise, actually down the block from us on 110 in Melville, owed the original owner owed $50,000 in sales tax. He transferred the business to another entity or another person. 19 years later, on a 20-year statute of limitations to collect in New York State walks into the food franchise and says, you don't owe $50,000, you owe $850,000. And the owner says, what are you talking about? I file on time. I pay on time. I've had this business for 18 years. There's no way I owe a penny. And it turns out that there would be transfer liability if there was a bulk sale. What I said to the gentleman when he called was, you have two options. One, you could hire me today. It'll cost you, representation fees. We'll ask New York State for a copy of the file. We'll do a Freedom of Information request. And they have the burden of proof that it was a bulk sale. Or if you could make sure that they don't take money out of your bank account for another year, I have an app on my phone that lists all the warrants. Call me back in a year and 2 weeks, and let's see if the warrant disappears. And that's exactly what happened. A year and 2 weeks later, they called me, I checked, and the warrant was gone. So sometimes you have to be a little lucky. But he was originally unlucky. He inherited $850,000 worth of a liability. And so you really got to check out, you got to do your due diligence when you're buying a business and do all the proper filings.
And I just want to remind our listeners that you're listening to Law You Should Know. We're talking with Karen Tenenbaum about sales tax and business tax and all kinds of tax issues and how she can resolve these problems for an individual, a business who has any kind of residency issues, sales tax issues, business tax issues, to resolve them properly so they don't come back to haunt you and you avoid the penalties, or she negotiates a settlement on your behalf. She's a CPA and an attorney who has a graduate degree, an LLM, we call it, in law, and very experienced in handling these issues. And you're listening to Law You Should Know on 90.3 WHPC, the voice of Nassau Community College in Garden City, New York. Karen, why don't you take a moment and give our listeners your website where you have information about many of these situations and how you make them less taxing?
Sure. So we're at litaxattorney.com, and you could always call us at 631-465-5000. And we have an app called Tax Helpline that you could download for free, and it gives you links to the IRS and New York State websites and some forms that you might need, et cetera.
And even if someone, and I'm sure people come to you where they have not filed a tax return in a while, and maybe there's some reason they have to do it, or they just got sloppy, or maybe it was COVID, what can they do under those situations to get back on track?
So I'm going to tell you the situation that happened last week. We were on a Zoom consult, husband and wife. He's a very successful attorney, making a lot of money. They had a beautiful house in suburbia. 3 children, happily married for 25 years. The daughter graduates from college and says, Mom, I'd like to have an apartment in the city. Can you co-sign the lease or guarantee the lease? So she says to her husband, can I have a copy of the tax returns? And he says, I haven't filed since 2014. And she says, what? You haven't filed since 2014? You're making all this money, all these years. My mother is 88 years old, and she... I have a joint bank account with her. We have a few $100,000 in it. you're going to owe $1 million between federal and state, 2 different states, New Jersey and New York. And do I even want to file a joint tax return with you? I was working, they withheld from my salary. Maybe I want to file separately. And what should I do? And their entire lives fell apart in front of me. She said, should I divorce you? Should I file with you? I mean, unbelievable. So we had them sign a conflict of interest letter, and we got retained, and we're solving both of their problems. But if you're a non-filer, so New York State has a voluntary disclosure program, which is unbelievable. It's a limited look-back period of 3 to 6 years, no penalties, and no criminal referral. So that's really important. And then you could file, I think the federal government has a 6-year policy that you could file back 6 years. So he would actually save by not having to file 2015 and whatever taxes that would have been in 2015.
So it's
now he didn't even know that. He didn't know that he prepared a tax return right before the consult, and he started giving me numbers of, for 1 year. He said, "How am I ever going to pay this?" And we said, "Wait a minute, you might not have to."
So it's always better to come clean with your help, and there are programs which they're mainly interested in getting their taxes. They're not interested in putting people in jail, especially if they come forward.
Yeah, to some extent, yeah. Now, we had another situation, and this was not a non-filer situation. This is somebody who wants to sell their business. He had a sales tax. He owns a restaurant. He had a sales tax audit many, many years ago. In the same year, he had a stroke. So he was not able to focus on the audit. The assessment grew to a very large number. Now he's 70 years old. Now he wants to sell the business. And I said to him, "Look, you might want to resolve the tax problem first. Let's either do an offer in compromise or something like that, so that we resolve it. And then when you sell the business, you get the money. Otherwise, there's going to be a bulk sale filing, and all that money is going to go to the government. So we'll be able to work something out with him." And a year from now, he said it's a very successful restaurant. I said, "Good. So a year from now, you'll sell it and keep the money."
And what are some other common tax problems among seniors?
So I would say the seniors have the issue of this residency. A lot of people want to retire to Florida. A lot of people may have even purchased a place many years ago, and that would be what they call a creeping change. So it's one thing if you say, "Today I left my job, I retired, or I got married and I want to move," or something specific happened on a specific date that made you move. That's easy when you have to prove, because you have the burden of proof by clear and convincing evidence. It's easy to say, "Here's the event, here's what happened, here's why I moved." It's much harder to say, I'll give you a perfect example. We know a guy who in 2014 bought a place in Florida. In 2015, he renovated it from beginning to end, added a pool, hired the best decorator. In 2016, he brought his entire art collection and his entire wine collection to Florida. In 2017, he did whatever he did. And in 2018, he got audited, and New York State sent him a bill for $250,000. And he said, "What are you talking about? I moved." And they said, "Prove it." And he said, I did all these things. And they said, "Well, that's a creeping change." And there's a famous case, Campagnola. You have ties here, you have ties there. That's not enough. So what we did is we stepped in and we said, "Look, normally you go to Florida from October through May. During COVID, you were not able to come back. You stayed much longer. So why don't we agree that you owe some money for 2018 and 2019, but get a change of domicile beginning in 2020. And what that does is we've been focusing on income tax for this purpose, but that's going to help you with estate taxes. Once you change your domicile, now you don't owe estate taxes in New York on your assets. So it's a win-win for him. And we were successful. So if you're planning on moving, you might want to do some planning in advance. So we know somebody who, unfortunately, his accountant handled the matter before he got to us. He was selling his business, but the year before he sold his business, he bought a place in Florida. He thought he did all the right things. Everyone thinks 6 months in a day, but that's not really the rule. And it turns out that he sold his business for $42 million and got a $6 million bill from New York State, because they said, "You didn't move." We were able to jump in and save some money, like $1 million in penalties. But the accountant gave them, I think, the 3-year contract showing that he was going to be a consultant for 3 more years after. And so that was a problem. So you really got to watch and plan in advance. You want to make sure that if you're making this change of domicile, that you're doing what you have to do. You're changing your home. You're changing the time spent, and that's not 6 months in a day. You're changing your business involvement, your items near and dear, and your family connections. Everyone thinks it's the driver's license, the voter registration, that too, but those are secondary. Those are, the first things I mentioned are the 5 primary factors. You have to leave here, land there, and show that you've changed your lifestyle. And
in changing your lifestyle, can you still do work remotely for some kind of New York business?
So that was the first thing we discussed up front. New York State says you haven't changed anything. You're still here if you were always here, but there are planning techniques. You can start a business there. You could open up an entity, rent a place, actually pay rent, and then maybe charge your original company some kind of management fee so that you're physically there and you work there and you have an entity there and it's separate from the original place. Often you see relatives that work together initially, father and son, something like that. You want to make a distinction. You want to separate it.
So there are ways to try to take advantage of you actually being in Florida and maybe doing some consulting or having some kind of relationship with New York.
Yes, there are planning techniques.
I just want to remind our listeners again that we're talking with Karen Tenenbaum. As you've heard, she's a tax attorney. Her firm is one of the leading tax firms in New York. She lectures at bar associations and accountant groups all over the Long Island, the New York City, and New York State. And she helps people and businesses resolve tax and residency issues, especially it may be a problem that requires a legal expertise with her accounting background. And if you missed any portion of the show, we want to tell someone else about it, please go to the podcast at nccradio.org. And you're listening to Law You Should Know here on 90.3 WHBC, the voice of Nassau Community College in Garden City, New York. Are there other ways that you help taxpayers with residency audits?
Yeah, so a lot of times the New York State subpoenas your cell phone records to see where you were. And what people don't realize is that it's pinging off the strongest tower, not necessarily the closest tower. So you claim you're in Connecticut, but it's pinging off a New York tower. And sometimes you have to go, sometimes the difference of a day makes a difference because we've been focusing on domicile, but there is New York State taxes you on all of your income if you're taxed as a resident, which is if you're domiciled here or if you're a statutory resident, which means you have a permanent place of abode here that's substantially maintained, which has now been defined. It was 11 months, now it's 10 months. And you're here more than 183 days. That's the 6 months in a day rule that everyone thinks. So sometimes a day makes a difference. So if you're in Connecticut and you drive over the border to New York to pick up the babysitter or go food shopping, that's a day in New York.
Or have dinner.
Or have dinner.
Or get a cup of coffee at Starbucks, yes.
That's right. But there are exceptions. If you're just traveling through to the airport or if you're here for certain inpatient medical treatment. But if you're in Connecticut and it's pinging off a New York cell, New York State may say you're here, but you weren't here. So sometimes you have to look at the details. We have a case where somebody swiped into a building in New York at the same time or within a very reasonable period of time that someone else was on that person's supposed to be on an airplane at an airport. There was no way to get from Midtown Manhattan to the airport and on the plane within that time frame. And we pointed that out to New York. We said maybe it was the wife that swiped in, and we were able to win on that day. Sometimes the day makes all the difference. So you really need someone who knows what they're looking for.
And what type of records do you recommend that people keep to prove they were not in New York or to prove they paid taxes or whatever else?
Yeah, well, there are a lot of apps out there that keep track of where you are. And everyone looks, New York State looks at your credit cards and other third-party support documentation to prove where you were. But it's your burden. You have to show, they assume that you're in New York unless you could prove otherwise. Sometimes you give someone your credit card and every month they just automatically charge it. That looks like a New York charge, but you might not have been here. So you want to go in detail, line by line, and make a calendar and make it easier for the state when they come in to audit you.
And certainly if you had dinner in another state, you're paying for a hotel in another state, or local bills for your residence in another state, you want to save all those receipts and documentation.
Yeah, and look, if you're as I said, if you're just crossing the border for something minor, that's considered a day in New York. And the second you hit over 183 days, you're taxed as a resident in New York if you meet the other requirements, having a permanent place of abode.
So planning is important, and if that fails, then explaining it with your help is the best option.
And like you said, keeping good records, keeping contemporaneous records, a calendar as you go, if you know that that's going to be an issue.
Karen, give us
and one thing that's important is domicile, once changed, it changes unless you change it back. But every year you have to worry about the day count. So the statutory residency piece is an annual thing.
Because New York wants a piece of your wallet.
Absolutely.
Karen,
and they're very aggressive.
Give us your website again.
litaxattorney.com. You could always call us at 631-465-5000.
And you do work with accountants also. If an accountant has an issue they're concerned about, sometimes people come to you directly, lawyers come to you, and sometimes it's accountants.
We get a lot of referrals from accountants, a lot of referrals from attorneys, a lot of referrals from happy clients, and the website, and people who know me.
And people can find out more about the free apps you offer to consumers and business owners on your website as well.
Yeah, just download Tax Helpline.
What do you see going forward? Just very briefly, what do you see going forward as we emerge from COVID in terms of enforcement and strategies to avoid excess tax liability?
So what I see is a lot of people, look, if the government tells you don't file your return, don't worry about paying, we've been lax for a year and a half, you kind of got lax. But now a lot of people, either they were out of work, they didn't have an income, they couldn't afford to pay their taxes, or they chose to take, let's say they have a restaurant and they chose to take the trust funds to keep their business afloat. And so now they have all this liability to the government. You really have to focus on it because they're going to come after you. That's really what it is. You have to be realistic that now's the time to deal with it. And as I said, we're getting phone calls regularly because once the government puts pressure on you, they're just taking the money. They're just taking the money out of your bank account or your wages, or collateral sanctions. They could take away your certificate of authority, which you need to have to collect sales tax or to have a liquor license. There are so many other things that they could do. They could padlock your place and auction everything off. All of these items are an opportunity to negotiate.
And it's certainly better if you come up with a plan before they come after you. You may have more options then. I'd like to thank our guest, Karen Tenenbaum. As you've heard, she's a tax attorney and accountant. And if you've missed any portion of the show, we'd like to tell someone else about it, you can go to nccradio.org. And please join us next week at this same time for another program on Law You Should Know here on 90.3 WHBC, the voice of Nassau Community College in Garden City, New York.